Hey everyone, welcome back to Corporate Decoder. Today, PNAQ just filed a Form 8K announcing the closing of their IPO and a material amendment to their underwriting agreement. And I'm seeing a few things that are key to understanding where this SPAC is headed. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company just wrapped up its initial public offering and made a significant change to its deal with the underwriters, and it actually impacts how much the company has to pay out. So, Pinnacle Acquisition Corporation, which trades as P.N.A.Q.U, has just completed its initial public offering, or IPO, selling 20 million units. Each unit comes with one Class A ordinary share and one right that essentially gives the holder a tiny piece of a share later on. They sold these units at $10 a piece, bringing in a massive $200 million. This IPO means that their units, their Class A ordinary shares, and their rights are now officially registered and trading on the New York Stock Exchange. This is a standard step for companies going public, and it allows them to raise capital from the public markets. Now, importantly, Pinnacle Acquisition Corporation is checking the box to say they are an emerging growth company. This is a designation that gives companies certain benefits and flexibilities under US securities laws, especially regarding financial reporting for a period of time after going public. It means they have elected to not use the extended transition period for complying with new or revised financial accounting standards. This suggests they are aiming to adhere to the latest accounting rules sooner rather than later. Okay, so here is where things get interesting with the underwriting agreement. Just a few days after their IPO closing, on the 14th of August, they amended their original underwriting agreement. This amendment is a pretty big deal because it directly affects the fees paid to the investment banks that help them sell their shares. What this amendment does is it removes a deferred underwriting discount for certain investors, specifically 2.25 million units bought by the company sponsor, Pennsylvania C Sponsor LLC, and its affiliates. Normally, underwriters get paid a portion of the offering price as a fee, and sometimes part of that fee is deferred, meaning it is paid out later, often upon a successful business combination for a SPAC. By removing this deferred discount for the sponsor, the company is essentially saving a significant amount of money. This change directly reduces the total potential payout to the underwriters. Without this amendment, the company could have paid out up to $6.2 million in deferred discounts. With the amendment, that maximum is now capped at about $5.3 million. That is a saving of nearly $1 million. This is a positive development for the company and its shareholders because it means more capital stays with Pinnacle Acquisition Corporation to fund its eventual merger. Let's circle back to the IPO itself. They successfully raised $200 million. This is the money they will use to find and merge with a target company. SPACs like Pinnacle Acquisition Corporation are essentially blank check companies formed with the sole purpose of acquiring another business. Almost all of the money raised, a staggering $200 million, has been placed into a trust account. This trust account is managed by a trustee, Continental Stock Transfer and Trust Company, and it is a crucial safeguard for investors. The funds in this trust can only be used for the SPAC's eventual business combination or returned to shareholders if no deal is reached within the specified timeframe. Notice that the amount placed in the trust account includes up to $6 million for the underwriters' deferred commissions, though we've just seen that this amount is being reduced. They've also provided an audited balance sheet as of the IPO date, showing the cash they've received from both the public offering and a private placement of units to their sponsor. This is important because it gives a clear picture of the company's financial position immediately after going public. So, looking at the overall picture, Pinnacle Acquisition Corporation has successfully completed its IPO and is now in the market looking for a business to acquire. The amendment to the underwriting agreement is a smart move, reducing potential costs and keeping more capital within the company for its future operations and merger. This is a common strategy for SPACs to ensure they have maximum flexibility and capital available for their target. Now, considering the broader context, SPACs have had a mixed track record in recent years. Many have struggled to find suitable merger targets or have seen their stock prices decline significantly after the merger. However, this filing focuses on the initial steps of raising capital and setting up the structure for the merger. The key for P.N.A.Q.U will be its ability to identify and successfully merge with a quality company in a reasonable timeframe. The reduction in underwriting fees is a good sign of financial prudence. The risk I'm watching is whether they can find a strong merger target that can justify the initial offering price and deliver value to shareholders. My biggest concern for SPACs in general is the pressure to complete a deal, which can sometimes lead to less than ideal mergers. What I'm actually looking for is their announcement of a merger target and the subsequent performance of that combined entity. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps. And subscribe for more deep dives. Check out the Discord in the description too.